Now speaking, Molly O'Brien, Vice President, Investor Relations. At this morning's Best Buy earnings call, CEO Corie Barry and CFO Matthew Bylunas discussed both GAAP and non-GAAP financial measures and forward-looking statements. The company provided a reconciliation of non-GAAP financial measures to GAAP financial measures in its earnings release, available on investors.bestbuy.com. The company also warned of potential risks and uncertainties that could differ materially from the forward-looking statements made during the call. Now speaking, Corie Barry, Chief Executive Officer. We are leveraging technology to better understand customer needs in the areas of their inquiries, so we can educate them more effectively on our products, services, and offerings. We have also rolled out a new computer-assisted call routing system, which uses natural language processing to route calls to the appropriate agents based on the customer's inquiry. Lastly, we are rolling out an AI-based virtual assistant to provide customers with answers to frequently asked questions. Our in-home sales experience is also being elevated by enabling our sales associates to spend even more time with customers through the use of mobile technology. Through our apps, we now have the ability to provide our customers with remote product selection and configuration as well as financing options without having to leave the house. This greatly enhances our in-home sales experience for our customers while allowing our associates to focus on what they do best, providing expertise and engaging with customers. Q1 sales results were in line with expectations and profitability was better than expected. Sales declined 10.1% year-over-year due to computing, home theater, and appliance categories. Digital sales comprised 31% of domestic revenue, similar to 2 years prior. Inventory levels were down 17%. My Best Buy membership program has 3 tiers and offers free shipping, exclusive prices, access to product releases, extended return/exchange window, tech support, and product protection. Omnichannel capabilities are being adapted to ensure leading position in digital age. 25 basis points of enterprise year-over-year operating income rate expansion expected in fiscal 24 from membership program. Headcount decreased 20%, 25,000 people, over past 3 years and consultation program lowered overall number of in-store consultants/designers. AI-based virtual assistant and computer-assisted call routing system used to enhance customer care phone experience. In-home sales experience enhanced with mobile tech for remote product selection/configuration and financing options. We recently launched a capability that uses generative AI to reduce the time our customer care agents spend taking notes during calls and improve cost and agent satisfaction. We are also piloting a virtual reality training and simulation experience for our in-home consultants and designers, which is expected to decrease costs and elevate specialized skills. We expect the consumer electronics industry to return to growth following 2 down years due to larger installed bases of tech products, natural upgrade and replacement cycles, and innovation from R&D spending. Our lapsed customers are also returning at higher rates year-over-year. We believe that our differentiated abilities and ongoing investments will drive compelling financial returns over time. Now speaking, Matt Bylunas, Chief Financial Officer. Q1 enterprise revenue of $9.5 billion declined 10.1% compared to last year. Non-GAAP operating income rate of 3.4% decreased 120 basis points and non-GAAP SG&A decreased by $40 million. Domestic segment revenue decreased 11% to $8.8 billion and comparable sales decline of 10.4%. International segment revenue decreased 11.6% to $666 million, driven by the negative impact of foreign exchange rates. Non-GAAP gross profit rate increased 70 basis points to 22.6%. Profit sharing from private label credit card arrangement was 1.4% of domestic revenue, a 50 basis point increase from fiscal 20. Returned $281 million to shareholders via dividends of $202 million and share repurchases of $79 million. Maintaining full-year guidance for enterprise revenue in range of $43.8 million to $45.2 million and enterprise comparable sales decline of 3% to 6%. Expecting 53rd week to add approximately $700 million of revenue. Enterprise non-GAAP operating income rate in range of 3.7% to 4.1% and non-GAAP diluted earnings per share of $5.70 to $6.50. Morgan Stanley analyst Simeon Gutman inquired, "Do you have confidence that the industry growth will bottom out in 2024, given that sales trends seem to have overshot this year?" Corie Barry replied, "We have seen the consumer exhibiting recessionary behaviors in the last year, specifically Q2 of 2020. According to industry sources including NPD, CTA and Forrester, we will see a turn in the business heading into the back half of 2021 and into 2022. We believe this is due to an increased installed base of connected devices, natural replacement cycles, and increasing vendor innovation. We are currently seeing these trends and they are expected to continue as we move into the next calendar year. Telsey Advisory Group analyst Joe Feldman inquired, have I correctly understood that the incentive comp for this year will go up significantly, despite the challenging circumstances, and can you explain why? Matt Bylunas replied, last year, we had a favorability of $455 million in incentive compensation which was not paid out. For FY24, we have added an additional expense of $225 million to reflect a normal payout, resulting in a year-over-year impact from almost 0% to a 1.0% payout. Telsey Advisory Group analyst Joe Feldman inquired, have there been any categories that have seen more promotional activity than expected and how have people responded to promotions? Matt Bylunas replied, we saw a heightened level of promotionality in 3 categories, appliances, computing and headphones, which was more than pre-pandemic. Vendors were incentivized to drive sales, however this did not lead to strengthened product margins year over year. Corey Berry replied, Joe, elasticity in the appliance category is currently lower than other categories such as home theaters since it caters to customers who need to replace something and are not as responsive to promotions. Overall, consumers now are looking for value and will respond to some extent depending on the category. Loop Capital Markets analyst Anthony Chukumba inquired, can you provide more detail on the divergence between domestic and international services business, which saw a strong comp increase domestically but a decline internationally, despite compare considerations? Matt Bylunas replied, we experienced growth in services revenue on the domestic side attributed to an increase in total tech members from last year. On the international side, there is some gross profit rate pressure due to similar membership changes being made in Canada as well as timing of those changes after Q1. D.A. Davidson analyst Mike Baker inquired, have the changes made to the membership business impacted the long-term outlook for profitability, despite guidance for no change this year being provided? Corey Berry replied, at the beginning of the fiscal year, we implemented changes to our membership program, specifically My Best Buy, the free program. We have an aspiration to make further changes to the other side of the program, and are in the process of finalizing details before announcing formal changes. Matt Bylunas replied, in the last 2 quarters, we have seen a gross profit rate increase of 40 to 70 basis points due to changes to the My Best Buy membership program. We expect this profit rate growth to continue into next year and further iterations and updates to the membership financials will likely bring more upside. As there are still members with 2 years of benefits left, the full benefit of this change will not be. D.A. Davidson analyst Mike Baker inquired, did I save $20 by not taking advantage of the free installation, but instead paying an annual fee? Corey Berry replied, we promised to offer great installation deals and are still doing so. Please don't worry yet, as changes were made to better understand customer behavior and adjust the membership program accordingly. The goal is to make customers more loyal, increase frequency and share of wallet, while balancing profitability impacts. J.P. Morgan Chase & Company analyst Chris Horvers inquired, have you seen any give back on the sales midpoint and operating margin range for the year, and what kind of scenarios are you preparing for to protect the bottom line in light of inflationary labor costs? Matt Bylunas replied, we did not comment on the EBIT midpoint. We have 40 to 70 basis points of gross profit rate to work with and no flow through for Q1. We want to leave ourselves room to navigate the remainder of the year, being prudent with decisions in the back half. Piper Sandler analyst Peter Keith inquired, have sales been impacted by the weak retail landscape and big-ticket discretionary items, or has the 10% decline from February's conference call remained steady? Matt Bylunas replied, we saw our sales sequentially get worse over Q1 with February being the best performing month. Our growth was slightly better than the guidance we gave, due to closing book entries and improving comps from April to May. We feel good about our Q2 guidance given at the start of the quarter. Corey Berry replied, since Q1 of last year, Peter has been consistently providing the best possible value and altering the membership program to meet the consumer's needs. With record high inflation in food, housing, and fuel, the consumer is making trade-off decisions. Despite difficulty in measuring exact share, Peter believes they are able to maintain industry share. The need for products in this industry is strong, with innovation cycles coming up to stimulate replacement and innovation cycles. Jefferies analyst Jonathan Midashevsky inquired, have there been any recent investments in the B2B channel of Best Buy business that have had a positive impact on the sales penetration? How is this business expected to perform in 2023 and beyond? Corey Berry replied, "Our direct team has achieved impressive successes since the onset of the pandemic, with growth outpacing our core. We are establishing creative approaches to technology-reliant industries such as education, hospitality, and sports teams. We are also working with home builders in a small pilot program. Our digital experience allows customers to purchase large quantities and target more potential small business owners. Our team is doing an excellent job creating capabilities to serve business customers, and we are proud of the growth seen in this part of the business." Oppenheimer and Company analyst Brian Nagel inquired, "So, my first question is, what gives you the most confidence that Q1 performance was the bottom and that we will see a rebound to normalized growth in 2024-2025? Corey Berry replied, "We have seen a pullback in demand for consumer electronics over the past 2 years, starting in Q1 of last year. Technology is necessary for our lives, and it is constantly evolving with features like AI, VR, and are driving form changes in products. This industry is unique in that people will always upgrade and replace their equipment, giving us confidence as we look to the future. We are monitoring the volatile environment, but our strong partnerships with vendors also give us assurance going forward." Oppenheimer and Company analyst Brian Nagel inquired, "Have Best Buy customers who are members seen higher overall sales than non-members?" Corey Berry replied, "We have seen an increase in engagement from customers, as evidenced by their increased spending and shopping across categories. After 2 years of the membership program, we have gained a lot of data on what customers value, which has enabled us to better acquire, retain, and engage customers. We can now bifurcate our customer base into different need states based on the data we have, allowing us to create tailored offerings that resonate with each group." Wedbush Securities analyst Seth Basham inquired, "Have there been any changes in morale among the store labor force since the implementation of new labor models over the last year? Could the lack of specialized roles negatively impact customer service levels?" Corey Berry replied, "We have invested hundreds of millions of dollars in wages, benefits, and career development over the last 4 years. Our hourly wages are up 25% and turnover remains very low compared to retail averages, especially for general managers, mid-single digits. We also see high levels of applications and measure employee engagement regionally, store by store." Guggenheim Partners analyst Stephen Forbes inquired, "Can you update us on your space allocation utilization initiatives and provide an estimate of where ROIC is likely to stabilize during the normalization period, relative to pre-COVID levels in the mid-20s? Matt Bylunas replied, "I expect ROIC to improve as the industry begins to turn around and sales grow. We plan to continue to grow our operating income rate by creating efficiencies and optimizing our business. I anticipate this will help our ROIC return closer to where it was previously." Corey Berry replied, "We have a strong history of maximizing return on invested capital, ROIC, and making informed investments, such as our experienced stores and outlets. We are seeing positive returns from these investments and remain confident in the future. We are still testing and evaluating ROIC to ensure we are delivering returns to our investors." Our annual shareholder meeting will be held virtually on June 14th.